on the breakout. Gold's going to make a new all-time highs.
Gold-backed ETFs seen inflows of over $5 billion.
$0.8 trillion gold market.
Why are we the only guys that seem to understand this?
Makes your head spin. Hi there, my name is Shane Moran, and I'll be your host for this episode of Live from the Vault. For the benefit of our new members all over the world, we're so excited that you're here joining us today. But Live from the Vault is really the place to find out about the precious metals market update and also to learn about the Kinesis monetary system. I just want to remind everyone, if you don't already know, Kinesis just released the Power of Minting video series that just launched. If you don't know about minting, Andrew Maguire will walk you through step by step on what is minting, why is minting so important, and why is it changing the face of the precious metals industry, and more importantly, how to get started in minting. Again, minting is something that is not available anywhere else in the world except for right here at the Kinesis monetary system. So Kinesis has really put together a great video series that really walks you through step by step what minting is all about. And for more information, just visit the link. We'll put a link down below here. And just before we go over to Andy and his precious metals update, I just wanted to let everyone know that their new build of the Kinesis Money Platform interface is coming out very shortly. People are working around the clock 24/7. It's amazing what's going on, but really what's being put together is to improve the experience of storing, trading, and holding with even our new virtual debit cards and how to spend your gold, silver, and cryptocurrencies. It's just never been easier than right here and right now. So look forward to that new interface. And with that, it's my pleasure to go over. Again, Andrew Maguire is not in his UK office. He's over in Switzerland and heading over to Liechtenstein. So with that, over to you, Mr. Andrew Maguire, for Talking Gold.
Thanks, Shane. Thanks for the intro. Look, this is just a quick market update from Switzerland. Now you can see I'm not in my office. In fact, it's exciting stuff. We're just setting up our new office and vaulting facility here in Liechtenstein. Now, I'm looking forward to when we can take you into this world-class Kinesis vault that's housed in a brand new 7,000 foot facility and real state-of-the-art stuff. So very proud to be here, but obviously apologies. Obviously the sound probably isn't as good as usual. And I'm obviously sounding like I've got a bit of a cold here, so I'm rolling with it. So if you can all roll with it, I'd appreciate it. But what I wanted to do, it's so important. I want to give you a quick update on the gold and silver markets following, really, and you can't, it's the elephant in the room is what happened last week. That was a counterintuitive sell-off. And where was it going into? Non-farm payrolls. And it's important to pass on where the wholesale market sees support in both gold and silver once you've had some sort of a chart-painted, counterintuitive attempt, really, at wrong footing. A lot of people. And I mean, look, it's not a conspiracy theory. All Fed events are historically heavy for gold. I think most people who look at a screen will tell you that is 100% correct. And of course, the Fed is active in all the markets, and as are their agent banks. So given the non-farm payrolls data is known a week in advance, and obviously the Fed knows the number, pretty much all the numbers are in by Monday. And so they've got 2 or 3 days of really inside information. And obviously their agent banks are party to that information. And what they did was they, of course, knew in advance that the Friday release was going to be a seasonally adjusted number, which is a first time ever. We saw that in jobless claims, which came through just before the release. Oh, by the way, we're going to seasonally adjust it. And of course, that ended up being a seasonal adjustment also in the non-farm payrolls data. And that was spun as a headline beat, despite what was going on under the covers of those numbers. But it was not difficult to commence grooming prices lower as soon as the market opened following the UK holiday. If you remember, last week when we go back, the markets really started on Tuesday. Now, the official non-farm payroll gaming that commenced last Tuesday morning, what it's done is grossly wrong-foot specs and enrich these insiders who, with 100% certainty, are an extremely long spot FX gold and silver into this non-farm payroll rigged gaming. Now, given the tight supply and the lack of T+2, which means 2-day deliverable, immediately deliverable bullion, wholesale premiums significantly rose into this officially driven event, telegraphing just how counterintuitive the paper-driven price rigging was. Had a load of people asking me, what's going on? You know, and especially as premiums were going up, we were saying, well, we're going to have to charge you more. So SI was heavily short sold the moment it tagged, and this is the easiest, anyone can pull up a chart here. Look at Tuesday morning. The moment it tagged the previously identified, if you remember, we said that the December options sweet spot was going to be 29,245. It's exactly the number. It hit that number. And ironically, when it was smacked down from there, it was into an incredibly strong silver fix, which was almost at that level. Then it rose a little bit into that options resistance. And then with the focus really on hammering gold futures down, really it was a question of using silver, which is often the case, to hammer gold down. So it was really just a question of, and I'm speaking as the wholesaler here, look, how much spec supply could you rinse out or wrong foot into even short selling, looking at these inflection levels? So really is what I'm trying to do now. It's our focus so that you get a better idea of the wholesale side of things. Now, we had multiple calls with all the dealing desks and liquidity providers, which identified where the largest spot gold and silver orders are aggregated. Now, these are important as dips below these levels will drive far too much competitive buying, and it's going to cost officials and insider banks too much needed short cover following this counterintuitive orchestrated surgical rinse of spec COMEX positions. We've talked about how this works multiple times, and suggest if you don't know what that is, please go back and have a look at some of the webinars. Now, in other words, this is a balance. The price is the balance between ringing the register and digging a hole. It's that simple. So, so as we know though, and we've discussed this before too, official currency interventions are fully accepted as part of the course. But taking the FX, the foreign exchange gold price too low, because it's deliverable, what it does is dry up the offer to sell real bullion. So who's going to offer it? Well, nobody with real bullion is going to offer it. A paper price maker might, but nobody who wants to sell real bullion. So offsetting this effect, 100% relies on wrong footing as many paper chasing speculators as possible, so that they can add that supply for the paper guys to gain. Now, if you rig prices below equitable supply-demand fundamentals, it further tightens up what little real bullion is on offer at market, which means here's the price. And it's immediately recognized by wholesale market participants who, as we evidenced last Friday, which was non-farm payrolls day, competitively jump in to lock in cheap spot index ounces and tons at heavily and unsustainable FX gold prices, which are, as I say, deliverable. Now, it's really this equation that determines the price support points. So what we have now is a lot of fiat chasing what little bullion is on offer, which further tightens supply, and the offer to sell bullion will rise to meet this demand. That's the game. Now, given the enormous paper market leverage, this has obviously a lagging effect, especially as this T+2 stuff has a couple of days to deliver. So ultimately, though, fundamentals will ultimately drive the chart painted technicals higher. And that's again, how it works. So in other words, what we're saying is how much wrong-footed non-delivery spec supply can be chart painted in with insiders taking the long side of each sale. versus competitive real market forces who recognize gold and silver prices are deeply undervalued and lock in the price for physical delivery. Now, these sorts of raids are not random. This was a careful calculation of just how much short cover that could be rinsed versus the exposure to this T+2 delivery demand. Now, the instigated silver short sell, I'm going to talk about the SI is the proxy, as you know, for silver futures. The instigated short sell from this 29,245 OPEX resistance was defensive, but it was geared not to allow a sustainable dip below massive insider and competing spot and related and strategically contangoed, and that's something, a discussion we don't have time to do today, but I'm going to discuss how this contango has been rigged. But essentially, so they didn't want it below the December futures below the 26,240 level. Now, this is a level where the largest competing foreign exchange silver deliverable spot index buy orders sat on Friday and sit now. Now, any spec-driven puke or short sell below this level cannot last. I mean, as has been evident since this resistance was breached 1 month ago on the 5th of August. So this pivotal level has consistently been front-run since December, since the December contract rolled onto the board. If you remember, September expired, December contract rolled onto the board. It was like something like a 30-cent higher price, and it kind of encompasses. So when we look at the COT structure, you have to encompass that. But really, what we're saying is, really, there's insufficient spec supply to rinse out that would easily enable insiders and spot indexes to lock in a price for silver. And you know, at these kind of levels that we're talking about, these breaching levels, these support levels where the wholesale levels are, the reason they are there is because the consensus sees a minimum price of $32 for silver and up to $35 per ounce. So that's the minimum expectation. So any dips below that level brings in competing buyers who also recognize that this is a great place to be entering the market. And I hope you can use that. And again, I'm not telling people to go out and borrow money and do this kind of stuff. What I'm saying is be aware of where those levels are. And that's what my job is today, is to tell you where these levels are, because what you're looking at is a chart-painted mess. Now, there is little incentive to allow silver to close below this level. And I was so certain the primary market-making insiders already are sufficiently long silver. And although they have the power of position concentration in the COMEX to do exactly what they did last week, that is, but they're also full-on long FX silver and will ultimately benefit from a price rise. Now, we also have fresh information that confirms JP Morgan has cornered the physical silver market. And I know there's been lots of talk about in this past, but this, I'm talking about what commenced in March. And we are now 100% certain that JP Morgan has now successfully gained full control of the largest physical silver stockpile in history. Now, there's going to be more on this in the future. It's also clear that this predatory Fed agent bank is largely immune from prosecution due to its federal government agency agreements. They're a primary dealer, amongst other things. And as I say, look, there's far more to this story than I'm at liberty to disclose yet. However, this is not bearish for silver, quite the contrary, in fact. Now, what's absolutely clear is that JP Morgan, as a company, will benefit enormously from a silver price rise. And this predatory insider will seek to capitalize on this when the least people expect it, and while fulfilling its role as a government agent bank, so largely immune. Now, in the meantime, well, fair or not, it is what it is. Now, in the meantime, we see silver building a base that is starting to attract too many competitors And with specs wrong-footed, the rally will commence when the least specs as possible are on board. That's how it works. Now, if you look at gold, well, let's talk about GC, which is the futures proxy for gold. It's a far opaquer market to read. However, the same actors are active in both gold and silver are clearly aligned for a price rise. And what we can determine is that the official non-farm payrolls gaming last week has also grossly wrong-footed gold speculators and enriched insiders whose footprints confirm they are extremely long spot gold into this rigged non-farm payrolls gaming. Now, just like in SI, there's a huge competitive spot-related bids, and where they are is at the prior 2011 GC 1923.50 high, which is now deemed to be support. And there's a hell of a lot of spot orders sitting waiting for this to be tagged. Hence the front running on Friday, despite this extremely so-called bearish for gold generated momentum. Now, notably, this prior resistance level has not evidenced a weekly close below this since the 31st of July. And any dip below will trip off very, very, very large competitive gold, spot gold buying. Of that, I'm certain. Now, as we discussed previously, on the other side of this week's surgical rinse of COMEX speculators, there are delivery obligations accruing in the larger over-the-counter spot gold delivery hopper, which so far was able to be offset by what was rinsed. And we just kind of went through how that was done. But with stocks testing all-time highs into very, very risky conditions, look, do we have to go into detail? What, 27 trillion in government debt, et cetera, et cetera, et cetera? I mean, really, you don't need any hedges? I mean, obviously there are fresh risk-on related hedging flows do have to flow into GC and SI as this bubble is chased higher.
Hi, everyone. Andy's just having a little bit of a technical issue over there in Switzerland. So let's just head back over. Andy, are you there? Are you ready to go?
Sorry, guys. I've had to put my headset on. Clearly, internet is playing up here. So let me just carry on. So basically, we were just talking about this rigged non-farm payrolls gaming. So look, like SI, there are huge competitive spot-related bids at the prior, and talking about SI here, at the prior, talk about GC here, at the prior 2011, if you remember, the 2011 high for GC or gold futures was 1923.50. Now that may vary a buck or two, depends on which chart you have, but that is now deemed to be support, hence the front running on Friday, despite the extremely bearish non-farm payrolls generated momentum. Now, notably, this prior resistance level has not evidenced a weekly close below this level since the 31st of July. So any dip below will trip off very large competitive spot gold buying. So now, as we've discussed in the past, on the other side of this week's surgical rinse of the COMEX speculators, there is delivery obligations accruing in the larger over-the-counter spot gold delivery hopper, which so far was able to be offset by what was rinsed. And that's how it works. This is the game. But with stocks testing all-time highs into very risky conditions, and if 27 trillion in US debt isn't enough to start wanting to hedge your risky positions, I don't know what is. But what we're seeing is fresh risk-on related hedging flows flowing into GC and SI gold and silver futures. Now, this makes it much more difficult to get the kind of downside traction required to do anything but slow the inevitable gold price reset. So look, for the technical guys, if you look at the ES, the S&P to the GC ratio, and you look at the S&P to the SI ratio, you'll see they converged. And they converged because they were simply overblown. In other words, the divergence between a rising stock market and these hedges had really been chart painted into oblivion. They're now closed. And I think that's a bullish sign too. Now, but as we discussed last time, even though we're talking about the big move here, and we talked about this big $6 move, long stop rinse in SI, which is a lot, and the $215 long stop rinse in gold that we experienced in August, even though it looks dramatic, all it served to do was rinse out the speculator fluff, who we all know never had any intention of taking delivery in the first place and had easily visible stops. So with the maximum gap closed, insiders and the strong hands are loading up long spot gold for delivery. It is galvanizing a higher, unrinsable support to build upon. And it's that simple. Now we see these bullish drivers already in play, and the only solution to reset the gold price will be through the unallocated gold and silver markets. And if you remember, we reported last time that the BIS had accumulated the largest ever long gold unallocated position in history. And these contracts will at some point be squared at a price point by way of a weekend cash settlement. A gold price reset is needed to square the books. Now, if you really want to dig a little deeper and think about how this gaming has really occurred and how it continues, is that we already, I think myself and all the brokers I know had to get rid of our US clients from our trading facilities, because if we were trading over the counter, i.e. FX gold, we'd have been blacklisted and delisted ourselves. So we had to get rid of our US traders who are forbidden from trading these contracts. Now, the reason I'm talking about this is because they were then siloed into the COMEX. So therefore you can guarantee there's liquidity into the COMEX, because basically you're forcing these guys in. However, I think it was a week, maybe it was 2 or 3 weeks later, then the CFTC made an announcement that, oh, by the way, when there's a market halt, there's going to be market halts in gold. X parameter, it will halt for 5 minutes. X parameter, it'll halt options for 3 minutes. Yet, these same market-making banks who are making markets on the COMEX are freely able to trade over-the-counter gold, FX gold, as I can, but no US trader can. So you can see how this setup stinks. I mean, it's basically what it is a rigged game. And obviously, if you are a paper trader, please make sure that you don't become part of the problem here. It's physical gold. Everything is about physical gold. And I think that's really what the one message I'm trying to say. You know, we can dig down into the COT reports and look at, and then say and tell you how they're offset by 10 times larger over-the-counter spot markets. But that's going to be invisible to many of the US traders. So, but really what I'm saying is, please, physical gold held in your name, whether obviously Kinesis has an ecosystem for you to actually use that as money, but make sure that your gold is physical and your silver is physical. When this price reset happens, you will benefit enormously. So really, I have to cut it here. It's basically just wanted to give you this last minute update while on my travels. We'll have a much fuller one next time, but I wish everybody a really, really pleasant rest of the week.
And there you have it, Talking Gold with Andrew Maguire. Thank you so much for that update. And now you know why people are fired up about getting, every other week getting updates on the entire precious metals market. And thank you so much, Andy, for that. I just want to finish off here and conclude, just to remind everyone to download the app, not now, but do it right now. You can have that app right on your phone. Just go to Apple, to the Apple Store, or even Google Play to download the Kinesis app. You can also refer, you can send it out to friends and family and people you know, either people, companies, or even government organizations. And don't forget to right now, not now, but right now, go over to the Power of Minting video series with Andrew Maguire and learn all you can about how to mint with Kinesis money. So with that, everyone, we'll see you in a couple weeks. My name is Shane Morand. Bye for now.